All right, well, welcome to this Spectra School Learning from Legends video. Today's topic is understanding financial market narratives, and I'm happy to have Dr. Ben Hunt on today.
Great to be here, Brent.
Ben is a good friend of mine. He's someone who I also look up to. He's a world-class writer, he's a money manager, and a fantastic human being. So, hey, Ben.
Hey, Brent. Thank you. That's very kind of you.
Sure. And I chose you for the first video of the course because I think you're the embodiment of how to succeed as a financial market professional by combining stories and data. So you publish a ton of writing and video on your website, Epsilon Theory, and I always felt like you're a consummate professional who does things the right way. So here we go. Do you want to give a quick background on your just your resume? Because I think it's interesting how you've stacked a lot of different disciplines on top of each other.
Well, I have done a lot of different things. As my wife says, I have a hard time keeping a job. But I started as an academic. You know, I got my PhD up at Harvard in political science, of all things. I was a tenured professor, but I always had the entrepreneurial bug, which I think is common to a lot of people in who get involved in markets. I love to play games, which I think is another thing that's very common to a lot of people who get involved in markets. So I had that entrepreneurial bug. I left academia to start a software company, sold that. I found that I really enjoyed the game of investing in companies. So I did some venture capital, some equity investing. And then honestly, a friend of mine who's the head of research at a long-only investment shop said, I mean, we're always talking about companies and you love to play games and you've got a perspective on investing. Why don't you come join me? We're starting up this hedge fund and, you can start playing the biggest game in the world, which is the game of public markets. So that was in 2005. I think so much of life is being in the right place at the right time. And 05, 06, 07, we did perfectly fine with our hedge fund, but, lots of people did well in 05, 06, and 07. In 2008, we had a great year when a lot of people didn't. So the money really came flooding in after 2008, 2009, we got up to about $1 billion in our hedge fund. But I tell you, Brent, you know this story. I think you probably lived aspects of this story, right? Starting in 2009, the returns on our hedge fund, which was, very much, I'll call it a value with a catalyst, kind of a typical type of strategy. Our returns really flatlined. We never lost money for our clients. That's something I'm still really proud of, and that means a lot. I love quoting from the Godfather movies, but there's that great quote. Hyman Roth, said, he never lost money for his partners. He always made money for his partners. And honestly, in this business we're in, Brent, that's probably the most important thing. It's a great advice.
Absolutely. Yeah, absolutely.
You always want to make money for your partners. So, we never lost money, but we weren't making what we should for our partners, for our investors. So we gave it all back, which was a pretty tough decision. But honestly, it's the smartest thing I ever did, Brett, because the other, I think, piece of advice I'd have for anybody in this business is that you have to play the long game here. This is a fantastic career to be in, playing the biggest game in the world, and it's a career for a lifetime. You can make a lifetime career out of this, but you have to think of it as playing the long game. So since then, so that was 2012, 2013, gave all the money back, and I started writing Epsilon Theory to try to figure out, well, how do you make money for other people? How do you find alpha? Where is that in today's market?
An interesting thing about, I think it takes a lot of courage to give money back, first of all. But I think an interesting thing that you observed at that time was that the quality of the water was changing. Can you talk a little bit about that? About how the water that you were swimming in was changing and you recognized that, I think, before a lot of other people.
Sure. And this is what I mean by what we did, value investing, fundamental analysis, looking at catalysts and the like. It stopped working. There was a change in the water, the investing water. And what I really realized, and we can talk about some of the specific events that led me to this realization, the events that were basically, kicking me in the teeth from, value investment with a fundamental catalyst approach. I was able to go back to my academic career, my software career, to try to evaluate, well, what does work? Because my instincts, and this is the thread through all these different jobs I've had, and it's the other reason why in this business of ours, having diversity of experiences and a background is really helpful. It's another good advice for people, right? You can come into this business late in life. It's not a bad thing.
It's interesting because one common thread I would say among people that I'm going to interview for these videos is that very few of them are highly specialized.
Yep.
They're much more stacking different things, quantitative, with you it's narrative on top of quantitative, on top of linguistic understanding. So I think that's an interesting point for sure.
That's so right, Brent. And even if you do start off in markets at an early age, I think the key, and this is part of what you're doing here with this series, is to keep your brain open for those different perspectives and experiences. It means everything. However you acquire them, whether you're taught them by someone like you or whether you get them through a school of hard knocks, it is those different perspectives that will pay great dividends to make a real career, a long career in markets.
Right. And one of the things that I learned from your writing, that's how I first became aware of you, was that you focused a lot on narratives. And I think as a participant in markets for a long time, by the time I started reading your stuff, I had a sense of there's more to markets than fundamentals. Like fundamentals, simply don't work a lot of the time, right? So that was part of the changing water after the global financial crisis, was that value stopped working, quality stopped working as markets became a bit of a political utility as opposed to a price discovery mechanism as government intervention increased. But one thing I wanted to ask you is if people understand that narratives and fundamentals are not the same thing, how would you explain the difference between narratives and fundamentals? Because I feel like there's some overlap, but they're also radically different.
Sure. I'll approach it from the perspective of a value investor, which is typically, I think, where most people start, right? I grew up in the church of value investing. I think most of it did. But what do you want to invest in? Well, I want to invest in a company that has, and we use quality and value kind of interchangeably a lot of times, right? But I want to invest in a company with a great management team. I want to invest in a company with, strong and growing earnings, a fortress balance sheet, all these words and phrases we use to talk about quality. And the value is that for whatever reason, the market doesn't recognize this, right? That's what value is. You're saying, hey, the market values it down here. I have this perspective and I see that it should be valued up here. Now, before I started really making I'll call it a real systematic study of narrative, the link between down here and where the market should be valuing it up here, and a lot of people do this, we talk about it in terms of a catalyst, right? What's going to change to make the market wake up and realize, we've been putting a 12 multiple on this, and it'll be a 14, or whatever your metric is for getting from down here in price to up there in price. And usually, I'll say fundamental investors describe that point of market realization and market discovery as being driven by a catalyst. Management change, stock buyback, new product released, M&A activity, whatever that catalyst might be. And that worked pretty well. I mean, it worked great for us, kind of like say 05, 06, 07, and in 08, because we were looking at the right catalysts. But one thing I realized kind of in looking back at that is that a lot of times you'll be a fundamental investor, a value investor. You'll say, oh, I'm waiting for this catalyst. The catalyst will happen, and the market yawns. Nothing happens to price. And you go, well,
right.
What the hell? I mean, that was the catalyst. Other times, you'll be long a stock, let's say, and all of a sudden, it takes off. It gets up to where you think it should be, but not because of the catalyst you thought would happen. And so it was kind of looking back on that, because I think, well, what does make the market value something at a price up here rather than a price down here? Mm-hmm. And what it kind of was like one of these aha moment things. It's just a story, right? What story is the market going to be paying attention to? Is the management team, and this is what makes for a good management team today, is the management team good at telling a story? Right. Are events happening in the world where, the sell side or market analysts can say, oh, here's a story for you? Because that's all a multiple is, Brent. That's all a multiple is. A multiple is a story.
But do you feel like there still has to be something real underneath? For example, AMC was quite a story with a CEO that was willing to pump an amazing story. But in the end, gravity won out because they issued so many shares and everything. So how do you try to find a good fundamental story and then predict the narrative shift instead of hoping for a fundamental catalyst? You're really looking for value with a narrative catalyst. Is that more like an accurate way to look at it?
That used to be where I was, right? But it's not today. So when I first started, I'll call it this journey, right? Mm-hmm. To use a word you use on like The Bachelor. Let's talk about our journey here, right, Brent? My journey as an investor. That's where I'll use kind of $10, economic words. I was a weak form narrativist, meaning that, it's narratives in the short run, but before long, reality takes over. Right?
Okay.
And then, I was going there were a lot of situations in markets where, I'm waiting. Why isn't reality taking over? And so then I became, again, to use the lingo, a semi-strong narrativist, meaning, honestly, narrative storytelling can last for a long time. Yeah. Right? But ultimately, when all is said and done, reality takes over. I got to tell you, Brent, at this stage in my journey, right, I am a strong form narrativist. I think it's stories all the way down, right? I think value is a story. Honestly,
right. So in the case of AMC, it's more that the story changed, not that the fundamentals were always terrible, but the story changed and the narrative changed, and that's what matters.
Well, yes. And you had some very good storytellers take the other side of the AMC bet.
Right. Okay. Right. So then,
once you start thinking of stories, it's not a static thing at all, right? So in our investment world, right, there are people on both sides of the trade.
Right.
You got people are bears and bulls, and what matters is how good of a storyteller are you?
As a strong form narrative guy, then you basically are more interested in tracking the narratives and much less interested in the fundamentals. And so what do you think the best way, I mean, obviously there's many ways because I know you use quantitative methods, but what are the ways that you then track the narrative and kind of figure out, because now we're dealing in a world where nothing is exactly real because it's more about the story than the underlying reality. So then it's obviously very important to be tapped into those narratives. What do you think the ways how do you do it? And then how do you think, a young finance professional entering the business can do it?
Well, I'll turn it around, Brent, and I'll ask, how do you do it? Because that's what you do. Right.
Right. It's a good.
That's what you do, Brent. And the more I get into I'll call it the quantitative and the systematic measurement of narrative. I mean, and we've gone way down that rabbit hole. I think we've kind of pioneered a lot of the technology here around natural language processing and, building language models to understand narrative and the like. But ultimately, Brent, all we're doing in our quantitative approach to this is we are externalizing what a good trader like you has already internalized.
Right. So you're providing a system kind of like the way a quantitative fund would, where they bring in a trader and they say, what do you do? And then they try to parameterize it and turn it into a system. I mean, I guess to answer the question, since you asked me, I mean, for me, I think that the most important thing is tracking just like what people are talking about.
Yep.
So
exactly.
For example, and it sounds kind of stupid, but for example, like I look at a lot of cross-market correlation. So, what does oil mean for the Canadian dollar? And I don't know, I guess I would say I'm more medium form, because in currency markets, there are definitely flows that result from trade balance and things like that are like more quote unquote real. But in the end, the only time oil matters for currencies, for example, is if people are talking about oil. If it's in a $10 range, no one cares.
No one cares.
But if it's making all-time highs, then the correlation between oil and the Canadian dollar skyrockets. And then I think maybe that's an interesting, you kind of threw it back to me, but it's an interesting way at the way quantitative analysis can kind of dovetail with discretionary, because the discretionary tells you what to look at, and then the quantitative can then give you some models to say, okay, when oil goes up this much, the Canadian dollar should move this much. However, that's only true if people care about oil. So interesting. You can do this loop between the discretionary and the systematic, where the discretionary view feeds into the systematic, and then you use data to try to uncover the relationship between price and narrative.
And this is why I'm a strong form narrativist, right? Which is that I let's talk about, something you write about, like seasonality, which exists. Momentum, price momentum, is a thing. It's a thing. Why is it a thing? Why should seasonality or price momentum in general be a thing? It's a thing because people think it's a thing.
Right.
It's a thing.
And technical analysis.
And that's fine. That's great. That's great. So, but it's a thing because people think it's a thing. And here's, to me, the secret of all of this, right, is not to rely on your own opinion of what's right or wrong or good or bad or true or false. And it was a really hard lesson for me to learn, because we all have pretty big egos in this game, right? And I came out of academia, like say out of software. I wanted to be right. And I cared more about being right, and I thought of myself as being right. It was as big an issue for me as making money, and that had to get drilled out of me really fast. But the way it really helped me kind of drill that out of me was to start reading and understanding that these ideas that you and I are talking about, Brett, they've been around for a long time. because I was academic, I had to read like John Maynard Keynes, his stuff way back when. The crazy thing is, and this is how people were different as academics back in the 1930s than they are today, John Maynard Keynes was a really good investor. I mean, he actually ran the endowment for his college. I mean, a not inconsequential amount of money. He was an economics professor, well known for Keynesian economics, but he was a CIO, right?
Right.
And he writes about it in his academic books. Crazy. No academics pay attention to these chapters because they're about, actually investing and trading,
right,
and what he called speculating, which is what you do, Brett, is what I do.
Yeah.
We're speculators, or that's what we would be called back in, the lingo back then. And he talked about, he would have his opinions on the world. He'd see the fundamental, he'd read the newspaper, he'd say, oh, this is happening in the world, I need to invest like this. Then he realized, that doesn't work out too well, right? The market does, there'll be good news and the stock price will go down, and for all the reasons that you and I know very well, right, is what we're always asking, what's priced in? What news is priced in?
And I think this is a really interesting point, because a very common mistake that people have made in the last 10 years is to invest or trade on what they think should happen instead of on what they think will happen. And I mean, you've made the point a bunch of times about markets becoming more of a political utility. And so, for example, in 2012 and 2013, people were screaming that the Fed should hike rates. But then, unfortunately, they were also putting money behind that opinion, which was more of like a moral outrage than a financial investment opinion. And I think that's an important lesson for people in general, is to not be too moralistic or deterministic about things. For example, like crypto is obviously the ultimate asset class where people are very religious one way or the other. And yet, we don't know what's going to happen. It might go to zero or it might go to 1 million. And it just serves you so much better as a professional to have an open mind. And an open mind doesn't mean you just have like an empty mind, but it means you're willing to acknowledge, like in kind of Bayesian style, that things change and you should update your prior evaluation of things as things change. And I think crypto is a great example of that. But then I think also the stock market, generally people have this kind of discomfort with stocks going up because it's government, intervention is bad, and people tend to be more free markets people. And I'm a free markets person.
Me too.
But in the end, your job is to make money or to make accurate forecasts. It's not to pontificate. So I think that's a really good point.
Amen, brother.
And I think you kind of realized that, right? Was that as it became a political utility, the reason to be a value with catalyst investors kind of gone. So why are you sitting on $1 billion of people's money? But it takes a lot of courage to pivot like that. So, I mean, I admire that.
Well, look, it was self-interested too, because getting back to that first thing you're saying, you never want to lose money for your partners. If you've got the wrong process, if you're thinking about the world in the wrong way, or if you don't get what really matters, at some point, variance happens and you're going to lose money.
Right.
And it was so much better. Because I didn't have an edge, I wanted to get the money back, because variance at some point I'm going to lose money. And
right.
Everyone I gave the money back to and I'd done really well for, they're all supporters of me now. Right?
That's an interesting point.
It's a long game. You're playing a long game here.
That's that was one thing that really struck me in Jesse Livermore's story, Reminiscence of a Stock Operator, is one funny thing about that book is it's a cautionary tale, but most people take it as like a how to trade guide, which it isn't.
Yes.
Because he went bankrupt 3 times.
Exactly.
But he always paid back the people, even though he was absolved of those debts, he always paid those people back. And again, I think that's part of why he has tremendous respect in the world.
100%. You know what, Brent, let me go back to this example that I was starting with John Maynard Keynes and how he actually did his investing, and the lesson that really brought forward for me, because it's going to advance this conversation of, well, okay, so we're kind of reading a lot, we're kind of getting a sense of where the news is going. We can be even more, I'll say, kind of prescriptive about how to do this effectively, right? So the first thing Keynes learned was, okay, it's not my opinion of what should happen in the world, right? Let's get that out of the way. But then he learned, you know what? It's not the consensus either. You don't want to invest on what everyone thinks, right? That doesn't work either. That Keynes was saying, and he's got this great example, it's called the newspaper beauty contest, that the way to figure out how a game works, this kind of game, right, the stock market game, what does everyone think that everyone thinks?
Oh.
Right? And you think, well, what the hell does that mean? When everyone thinks it, it's what, there's technical names for this. It's called common knowledge. Right? It's what everyone thinks that everyone thinks. Sometimes you'll hear when they talk about earnings, what's the whisper number, right? That was the thing that they used to, probably still do, talk about stuff. And, talking about ethics or what a central bank's going to come out with, right? What's the tone going to be? Well, you've got the consensus. Here are the estimates. Here are the analyst estimates. But what does everyone think that everyone thinks?
Right.
What are the expectations of the consensus? In other words, the consensus of the consensus. And it's looking at that and understanding how that changes. That's where I think there's the ability to learn how to effectively look at information. For example, when I see a story, a narrative, we'll pick on some equity sectors for a second, right? We're bullish on financials. Oh, yeah, we're bullish on financials because we got a steepening yield curve. We'll talk about that. And we're bullish about financials because, steepening yield curve, so we've got net interest margin, and, we've got some regulatory forbearance coming down the pike. They'll be able to, use more capital for stock buybacks. And we just had earnings season, and the first three banks that report, had good numbers. We're bullish on financials. If you're kind of engaged in that right then, and this is happening, and you kind of see this snowball at the top of the hill and start rolling down, you can get involved. You can do it. I tell you this though, Brent, by the time Kramer is talking about this that night, or by the time it shows up in your Bloomberg email the next morning, analysts are very bullish on the financials. Brother, it's time to fade it. It's time to fade it. To your point, Brent,
right.
What we're looking for is the ebb and the flow of this narrative. You're not just going along with the consensus. You're understanding that price and common knowledge, it goes down here, it goes up there. We're looking for when it's overbought, oversold, all using those kind of words. What I'm saying is you can look at story, look at narratives as a really good signal for those kind of price opportunities.
Right. So almost following the momentum of the narrative as compared to the price. I mean, that's why I think generally people get killed trying to short bubbles, because those narratives are really exciting and there's amazing stories behind them that are somewhat real. And so people try to fade that because it's a bubble or it's way too overhyped, but that overhyped status can stay for a long time. And I think that's where in this course, we talk a lot about combining narrative or stories with data, because I think most of the people that are good in the market don't do one or the other, with the exclusion of some systematic hedge funds. Generally, people have some kind of mix. So you can use overbought and oversold, but then you can use positioning. And then you can also use more specific data, like in crypto, people use search data because crypto is essentially about attention. So as attention declines and search volumes decline, very often the price lags and then the price comes down after. I think the Keynes Beauty Contest is really nice too, because it speaks to how everything, and I mean, you can go crazy with the derivatives, but everything in markets operates on the second or third derivative. And so the first derivative is steepening yield curve, banks are going to go up. And then the second derivative is like, have banks gone up already?
Yep.
And then the third derivative is everybody long banks? And then the fourth derivative is like, what's the momentum of the price, but what's the momentum of the buying flow and all that kind of thing. So I feel like, I mean, that's what makes markets so interesting, but also so difficult, is the one thing that's funny is that journalism and the financial journalism that people consume tends to be very first derivative, because everything else just sounds like gobbledygook, right?
And Brent, this is the point I would take from what you described, which is 100% accurate. The vast majority of market participants never get past the first derivative, right? So there is a long and fruitful investment career ahead of you if you can just get to the second derivative.
Right.
Just
and
get
actually,
there,
a question,
you'll be fine.
Right. And I think that's a great point. One question that kind of relates to what I just said, but also just a question I have for you in general, because I've never asked you this, is I would describe you as like one of the world leaders in narrative analysis, going all the way from your work at Vanderbilt and your, obviously your education as a professor, but then in finance. But how do you differentiate what you do from behavioral economics or the common Tversky kind of stuff? How is it different, or how is it the same?
So what I'm so keen to do is to move beyond anecdote and to move beyond, I call it pathology. And what I mean by that is, I took a class with Amos Tversky, right? And all of that work is spot on. It's very good. It's true, right? We humans have a number of these, let's call them cognitive failings when they process information. Mm-hmm. Stipulated, right? But what I'm trying to do is I'm trying to make money. And so what I would say is that there is not just these, I'll call them cognitive failings. There is actually a logic and a rationality to the way that humans process information, to the way that most of us stop at the first derivative, to the way that certainly when a sell-side analyst is writing his or her report, you're going to stop at that, first derivative, because that's the story that sells. Right? That's how our brains are hardwired to respond to information. We're hardwired to respond to those first derivative. Oh, this happened, therefore good news, stock up, right? Or just something along those lines.
Like the first derivative cause effect kind of thing, right?
It's how we're wired, man. Right. And so what I'm trying to do is I'm trying to move beyond a guidebook of, watch out for this, narrative, cognitive fallacy, watch out for that, which you can always kind of identify them. And yes, I'm prey to them just like everybody else. What I'm looking to do is trying to say, well, what's a broader pattern here? Is there a logic behind that, a rationality behind why we react the way we do? And can I develop an investment strategy around that? So look, all the behavioral economic stuff, I think it's very important. You should absolutely know it, because it's a checklist so that you, Brent Donnelly, when you're sitting down at your desk and, looking at your screens, that you don't make those mistakes, or you minimize those mistakes, especially we can't eliminate them because we are just human.
Sure.
I'm trying to go I'm going to say it's one step further. It's a different approach, right? I'm trying to use these insights to say, well, is there something actually more general and predictable and rational that I can measure and actually build a direct investment strategy around it? That's the difference.
So kind of connecting the individual bias to potentially group bias, or just patterns in the market that may or may not be related to those. So there's some connection, but a lot of times there might not be a connection to the individual.
That's the other really important thing, which is that, the work around these cognitive biases and the like, it's focused on an individual action. What I'm describing what Keynes was describing when he's talking about the beauty contest, when we're talking about common knowledge, the way that narrative spreads through a crowd, is that there are actually these crowd behaviors, which a market is more than there are emergent properties that come out of a market that you wouldn't expect or analyze just by looking at the individual participants. It's the same way here as well, right? There are emergent properties when you look at an enormous crowd of people, all of whom are subject to some of these cognitive biases, but there are other factors at work as well, other game playing at work as well. And that's really what I'm more focused on.
Right. Okay. And I mean, I think this has been awesome. I think we can probably wind it up around here, but I wanted to ask you one question. So when I started in the market, the era was the 80s. It was Gordon Gekko and like Liar's Poker.
Yep.
There was quite a lot of bad guys in the story of the market. And one thing that I found really interesting over time was that actually most of the successful people that I've interacted with are pretty nice people that generally do the right thing.
Yeah.
And of course, every part of the world, there's psychopaths or sociopaths in every industry, and they got a lot of airtime in the 80s. But do you think being a nice guy or being a nice person has given you an edge? Or how do you feel, how do you think about the whole how to behave as a financial market professional?
Yeah, no, it absolutely gives you an edge because you are playing for the long haul. And part of it is being, as you say, a nice person, right? Forgiving, sharing of information and ideas, all of that is very helpful for developing an ecosystem of similar people who play that way, right? Who play the game that way. And that if you can build a population of people like that, then that can really sustain you, and that population does better than the rest of everyone by cooperating with each other. Right? That's point one. But here's point two, which is that our business is a reputation business, period, full stop. And once you damage your reputation, you can never come back from that. I mean, I really mean that. You can never come back from that. So you got to think of your reputation as like a teacup. And if you break it, I mean, you can glue it back together again. You really can. Mm-hmm. But what you have then is a glued together broken teacup. It's never it's never the same. So, the couple of pieces of advice that I got when I first got in this business, and I want to, encourage all your viewers to think the same, right, is that you are playing a long game. Your reputation is the thing you have to preserve and protect as you go through all this. And, part of that reputation is, yes, making money for your clients, not losing money for your clients, but being honest with them and yourself about when you've got an edge. Right? So I think if you remember all that, you'll do well. And frankly, I think that for me at least, it became easier to recognize where I've got an edge and where I don't once I started understanding that everybody's telling me a story. Doesn't mean they're a bad guy. I mean, if you're an analyst, you're telling a story to your PM. Right? If wherever you are in our ecosystem, you're telling a story to somebody. We're all storytellers. And we have to recognize that, it doesn't mean that people are lying to us, but it means we need to recognize the storytelling. Because, yes, it's important to be nice. Yes, it's important to share. Yes, it's important to be honest and maintain that reputation. But what's also important is to not be a patsy.
Right.
Right? It's the old line about poker. You've been playing for 30 minutes and you don't know who the sucker is at the table. It's you. Right? Don't be a sucker. And the way that people get suckered in our business is They believe the stories that they're told. It's not that people are lying, but maintain that sort of critical distance. Always ask yourself, why am I being told this story? Why am I reading this now? Why is this person telling me this? Again, not that they're lying, but that, they're telling you a story just like you do, and you need to maintain that critical distance at all time. Recognize the storytelling for what it is. And then it makes it a lot easier to be a nice guy.
Awesome. Well, that's fantastic advice. I wish I got that advice when I was in my 20s.
Yeah, me too. Me too.
And so thanks so much, Ben. Thanks. I really appreciate your wisdom and your friendship. So thanks so much.
Right back at you, Brent. Thank you.